All right, so welcome back again. Right, so in this section, we'll be looking at risk management in trading and why risk management is very, very important, right? Why, as a trader, you actually need to pay attention to your risk. So at every point in time, you want to click the sell or the buy button, right? So you want to know exactly how much are you risking, right? So you need to know how much you are willing to let go, how much you are willing to lose, right? So everything in trading, right, starts and ends with risk management. So risk management is like the hallmark of trading. Now, no matter your trading system, your trading style, if you don't have a good risk management plan, you cannot be profitable, right? So risk management is very, very vital. So even if you don't have a good strategy, right? If you have a good risk management, you can tweak your strategy by using the risk to reward ratio and make yourself profitable. So I'll be showing you how to do that as you progress. Now, let's try to understand the theory or the idea behind risk management before I show you how you do the whole calculation and the rest. So risk management is the process of you analyzing, right? So after your analysis, you should be able to quantify, right? You should be able to know, okay, how much am I willing to lose, right? So after the quantifying of the amount, you need to be able to accept it. So if you accept the risk, then you can go ahead and click the buy or the sell button. But if you did not accept the risk, then no need of clicking those buttons. This is one of the things that's going to help to keep you in check, right? Then at every point in time, you need to always plan your trade and trade your plan, right? You need to plan your trade and trade your plan. So stick with your plan. You need to, right? So you need to know yourself because a non-examined trading life is not worth living. So you need to, by planning your trade, you'll be able to know yourself by keeping yourself in check. Maybe when the trade is going against you, because there are the psychological aspects of trading, right? That nobody can teach you. It's only you yourself that can teach yourself. So you are going to learn it in the process. You are going to develop it in the process. And some of these things you'll be able to develop it by the time you have a good risk management plan. Now, the best way I like to approach the market, or the best way I like to approach things, right, is to always think of losses first before executing my trade, right? So at each time I want to open a position, I always like to ask myself, right, how much am I willing to let go, right? So for me, it's more like waking up every day and ready to lose. So I already have once I have a position open, I've already made up my mind that okay, the money I've put in that position is gone, right? Then if the market goes in my favor, fine, right? I'll be happy. But if the market goes against me, I'll still be fine because I've already made up my mind and I've accepted the loss, right? So if you're able to accept your loss before executing your trade, it's going to help you, right? It's going to help you should in case the trade is going against you. So you need to think of losses first, right? So stop thinking of how much am I going to make in this trade. Think of how much am I going to lose in this trade. So this will help you a lot in your journey as a trader. So when you think of losses first, one of the what it does to your psychology or what it does to your mental is that you won't close trade too early, right? And you won't be scared when the trade is turning into a losing trade. And also when the trade finally hits stop loss, right? You can easily move on quickly, right? Maybe one losing or two losing trade can ruin your day because you've already accepted the loss. But when you've not accepted the loss, one losing trade can even ruin your day and even made you another setup that's supposed to give you profit. You might not take it, right? So that's why it's good to plan your risk at ahead. Now, for us to actually understand risk management proper, right, and the whole risk management calculation, I like to go back to the first principle, right? We'll be looking at the position sizing. Now, we have what we call the lot size, right? So lot size is the buying or selling power of a trader on an asset, right? Now, it's a function of a trader's account size. Now, let me bring it to what you can relate. Take, for instance, if I have $1,000 and you have $100, now you agree with me that, let's say that we are in the supermarket. Let's say we want to buy noodles. You agree with me that the number of cartons of noodles I will buy with $1,000 is going to be bigger and the quantity much than the number of cartons of model you will buy with $100, right? So that same thing is what happens in the financial market. So lot size is the buying or the selling power of a trader on an asset. So it's a function of your account size. Now, the larger the account size, the more of the contract size you'll be able to buy, or the more quantity of an asset you'll be able to buy. And the lesser the account size, the lesser the quantity of asset you'll be able to buy. And when you have large amount of the assets, in terms of the market running in your favor, you make more profits. Also, in terms of the market going against you, you still make losses as well. Then when you have a lesser amount of the assets, if the market goes in your favor, you make profit, but the profit might not be reasonable. Right? So in the financial market, especially for the currency market, right, there are three major types of lot size, right? There are three major types of lot size. Now we have the micro lots. Now the micro lot size, it represents 1,000 units of an asset, right? And it has a volume of 0.01. Now, and it has a profit of $0.1 per pip. Now, if you've not gone through the introductory video, right, I will advise you go through the introductory video. I will still link it in this video. So in the introductory video, we look at what is called PIP, right? And the whole of that. Now, price movements in the currency market, that is in the forex market, price movements are measured in pips, percentage in profit, right? So PIP is to us traders what meters it is to engineers, or what the yeah, what meters is to engineers. So the price movements in the forex market are measured in pip. So that means if you are using micro lot size, you can only be able to buy 1,000 units of an asset. And if the market moves by 1 pip, you are going to be making a profit of $0.1. Now, we have the mini lot size. The mini lot size represents 10,000 units of an asset, right? And it has a volume of 0.1. And it is $1 per pip. So that means if the market moves by 1 pip, you're already making a profit of $1. Now we have the standard lot size. The standard lot size represents 1,000 units of an asset, right? It has a volume of 1, and if the market goes in your favor, you make $1 per pip. So if the market move by 1 pip, you make $10. Sorry. Then also if the market goes against you by 1 pip, you also lose $10. Right now, this is the table that just summarize everything. The profit you are going to make per pip based on the lot size you are using, right? Now, you might not ask yourself, by using standard lot size, you can be able to make $10 per pip. Now, why don't you trade with standard lot size? Now, this is now where a function of your account size comes in, right? So if your account size can carry the margin. I will still explain what I mean by margin. So if your account size can carry the margin, I will stand the drawdown for one lot, then you trade with one lot and above. But if your account size can't carry and we start the drawdown of standard lots, then that is now where you might use micro lot or mini lot. Now, that is the whole idea of what we want to do in risk management. So as we progress, I'm going to show you how you be able to do calculation, right? Because you don't just want to wake up and choose any arbitrarily lot size and start using, right? So as we progress, as we go on in this course, I'm going to show you how you are going to, there are some calculation you will do. So it's now from the calculation that you'll be able to know the lot size to use. Maybe let's say you want to risk $1 on a 6,000 account, you want to risk $10 on a 6,000 account, right? So there are some calculation you do. At the end of the calculation, you'll be able to know how much you are how much you will be able to know the lot size to use, right? So stay with me, I will still show you how you do that. Now we have what we call the leverage. Now this is very, very important. We have what we call the leverage. Now leverage simply means the money a broker, right? In the forex market, we have what we call brokers. So if you still don't know brokers, I will refer you to go to the introductory video. Yeah, so the broker, the broker will give you money to trade. Now, the broker understand that you might not have the capacity, right? You might not have the capacity. So they are now helping you. They are giving you money. They are borrowing you free money. They are giving you free money to trade. Now, this is the game. Now, leverage is like a two-edged sword, right? So if you understand how to use it, you are going to use it in your favor. But if you don't understand how to use it, you are going to burn yourself. So basically, what happens at any point in time you want to open a trade is that the broker the broker brings 99% of the money, while you are just bringing 1%. Now, the 99% of the money that the broker is giving you or bringing on board anytime you want to open a trade is what we call leverage, right? Now, why the 1% you are going to bring on the table is what we call margin, right? So I will still explain margin, right? So margin, but for now, just see it as like collateral. Let's say that you want to go and borrow money from the bank, right? You know that you need to keep something on the desk. You need to drop something on the table. You need to keep a collateral. So the same way it is, whenever you want to trade, you have to keep a margin, right? So you have to keep something as a collateral to be, this is to make sure that you don't lose their own money and you don't lose your own money. So I will still explain that as we progress. Now, leverage is always quoted as a ratio of your account size, right? Maybe when you are creating your trading account, there are, depending on the broker, there are, you might be seeing 1:1,000, 1:500, 1:2,000 or thereabouts, right? So whenever you want to place a trade, your broker brings the 99% while you are just bringing 1%. So that is the importance of leverage. But now this is the game. Remember, this is, they are borrowing you money. So like I said, it's like a two-edged sword. So you need to know how to use it. If you know how to use it, you'll be profitable. But if you don't know how to use it, you burn yourself. Now, leverage is a non-refundable money, right? It's not refundable. So now, when you are using high leverage, it's not refundable. And if the trade goes in your favor, you are going to get or make more profits, right? But if the trade goes against you, you are going to lose more depending on your level of risk management. Now, for those of you that also trade crypto, I believe maybe you might have watched the video I did on how to do your position or calculation, or how to do your sizing for the crypto assets. Where I made mention of liquidation price and how I showed you that you can actually adjust your liquidation price by adjusting your leverage. Now, leverage applies to all CFD, right? All CFD. What I mean by CFD are contract for difference. So all the contract for difference market has leverage. There are leverage products. So whenever you see leverage, the same way leverage is applied in the currency market, the same way it is applied in the cryptocurrency market, the same way it's applied in the stock market, the indices market, or whatever. So leverage is leverage. Now, one thing you should bear in mind at this point is that you shouldn't over leverage. Now, if you know that you are the type that don't know how to use leverage well, I would advise that whenever you're opening your brokerage account, use the lowest leverage. Now, when you use the lowest leverage, what it simply means that your margin will be big. So now that means if your margin is big, the money you are keeping aside as collateral will be big. So if the market should get against you, you still have more money to play around with, right? But when your leverage is high, right? When your leverage is high, your collateral will be less. So that means if the market goes against you, what you have left will be so small, right? So if you are still having issue with leverage, or if you don't know how to use leverage professionally, right? I always advise that you don't over leverage. You can start with the lowest leverage. I will still explain this as we progress. Now, margin. Let's look at margin. Right? Margin is the amount of money, right, required to keep a trade open. Now, this is not a transactional cost, right? It's just like a money you set aside as a good faith deposit, right? So margin is that 1% you as a trader will put into a transaction while your broker is bringing the 99%. Now, you can actually calculate your margin, right? So if you want to calculate your margin, this is the formula to calculate your margin. Even though I will show you how this is. Your MT5 is already doing this automatically for you, right? But I will still open position and show you the effect of some of these things, right? So stay with me, get the understanding. I will open position to explain these things better. So margin simply means for you to get your margin, you do the unit of the asset, maybe how many lots you are trading over leverage. With this, you can be able to get your margin. Now, for the margin calculation, take for instance, if a trader has $100 in his forex account and is operating on a leverage of 1:2000, and let's say that the trader wants to trade GBP with a contract size of one lot, right? And you know that one lot represents 100,000 units of an asset, right? That is the base currency. Then the required margin is calculated like this, right? Since margin is unit of asset over leverage. Now the unit of assets here is one lot, which is 100,000, right? So, and leverage is 2,000. So when you do 100,000 over 2,000, is going to give you, when you divide 100,000 by 2,000, I'm going to get $50, right? Now, what this simply means that for this trader, we need a minimum of $50 in his account to be able to trade with one lot. So now what this simply means, now let's say that you have $100 in your trading account and your leverage is 1:2000, and you want to trade GBP with one lot. So that means you can be able to trade GBP with one lot as long as the money in your account is more than $50. So the minimum you need to have in your account is $50, right? So if you have $55, $60, you'll be able to trade this one lot. But now here's the thing. Here's the thing. Remember, since you are trading one lot, right? If the trade goes in your favor, if the trade goes in your favor by 1 pip, you are making $10. If the trade goes in your favor by 5 pip, right, you are making $50. Also, if the trade goes against you by 5 pip, you are losing $50. So that means your margin is tight, right? So you are not having enough breathing, you are not giving your trade enough breathing space because 5 pip is very small. Okay, let me go to the chart. Let's say that maybe let me just bring this measuring to okay, price range. So 5 pip might just be something like this, right? Depending on the asset, right? Depending on the asset. Let's say maybe let me open EU, right? So if I'm on EU, so 5 pip might just be something like this. So imagine if price just go against you by a small distance like this, you're already losing $50, right? So because your margin is tight. So that's why I will never advise anybody with an account size of $100 and below to even use standard lots. In fact, you shouldn't even use mini lots. So if you are trading $100 and below, you have to be using micro lots. Don't even think of using standard or mini lots. That is unless you just want to gamble in the market, right? So what this means, right, instead of the importance of margin now comes in. So instead of this trader, right, with one lot, instead of you bringing the full $100,000, you are just bringing $50. You are just bringing $50. Why the broker is bringing 99% of the broker is bringing 99% of this $100,000, right? So that is the importance of leverage and margin. Now, when you take a high leverage, right? When you take a high leverage, the effect is that the margin with the broker will become small. And you know that what is with the broker's margin is the only save money that you have. So if the margin is small, so that means what you have left or what you have if the trade should get against you is just small. What you have left is small, right? So and also under extreme volatility condition, right? Stop loss might not hold. So the only money that has 100% safety is your margin, and that is always with the broker. So in essence, you shouldn't over leverage, right? Don't use high leverage unless you are professional and you are too sure, but you can't be too sure of anything in the market. So that's why risk management is important. All right, so let's look at equity. Now, what is equity? Now, equity is the amount of money that you currently have in your account, right? When your trade is currently running in profit or in a loss, right? So I will still show you this on the MT5 on a running trade, but I want you to get the idea of what I mean, right? So equity is the amount of money you currently have when your trade is either running in profit or in loss. So that means equity is equals to your initial balance plus profits, or your initial balance minus loss, right? Your initial balance plus profit, or your initial balance minus the losses when the trade is currently running. So that means when a trade is current, that means for you to regard it as equity, the position should currently be on. So once you close a position, it's no longer an equity. Everything now turns to balance. So when you have an open trade, your equity is your account balance before you open the trade, right? So that is this formula plus the profit if you are in a winning trade, or minus profit if you are in a losing trade. Now, another way for you to get to equity, right, is by doing free margin plus margin. Now, these formulas, right, they've been automatically done in your MT5. So your MT5 or MT4 is automatically doing this calculation. But is always good that you understand how everything works under the hood, especially for people like us that are into quant, right? And writing your algorithm, in developing your trading system, you need to understand the formula that you are implementing so that you can be able to turn that formula to code, right? So that's why it's good you understand how everything works under the hood, especially if you are a quant trader or if you're a developer like me. But if you are just an ordinary trader, right, most of these formulas, MT5 have already implemented everything for you. So you might not need to stress yourself on how you implement it. Then we have what we call the free margin, right? So the free margin is the amount of margin you have left to place new trade, right? So once you've opened a position, right, and your margin has been removed, right? Remember, margin is the amount of money required to keep a trade open, and it's not a transactional cost. It's just money set aside as good faith deposit. So once your margin has been removed, then from your remaining balance, right, you cannot be able to see free margin. So it tells you how many margins more can you use for other trades, right? So your free margin is your equity minus margin. When you subtract margin from equity, you are going to get free margin. So that is the amount of margin you have left to place new trades. Now we also have what we call the margin level. Now these things are mentioned, and I'm going to show you on the MT4, right? I'm going to show you these guys on the MT4. You have what we call the margin level. Now margin level is equity over margin, right? Equity divided by margin times 100%. So when you do equity over margin times 100%, you'll be able to get the margin level. Now, I think this video is becoming, so I want to call this so that it won't be long. So we continue from the part two. So in the part two of the video, I'll be explaining this forex calculator and some other forex calculator and how you can use them to do your position sizing effectively. So stay with me.